there's great value in you having to talk it through without just reading it through, or without just reading through it. So it's the reason I do it. I can't think of a different way to do it since we're on a Zoom call or on a webinar or conference call. But the idea is to get you thinking about it and having to verbalize it, and you'll learn it a lot better if you'll take the time to do that. So if it sounds a little, wonky or hokey to be able to do that, understand it's the next best thing to be able to turn to your neighbor, a stranger, and explain it that way. So that's why I do it that way. John liked the talk it through exercise. Good. And John, more importantly, thanks for being on mute so I didn't have to listen to you explain it to yourself. I appreciate it. Jamie was asking, can you explain the $1,000 trade size again? Do you want options up to $10 in amounts that don't exceed $10 cumulative? Like 6 and 4 or 5 and 5? Thanks. So Jamie, starting off, when you're looking to trade an option, and what she's referring to is here. So we're going to trade with a $1,000 trade size, same size trade, start a buck profit, etc. When you go through and look at an options chain, you're going to find options that range in price all the way down to 25 cents up to, you're going to see some on expensive stocks way out in time that could be almost $100 or even more. When you look at that options price in the options chain, you just have to add 2 zeros to it. That's how much it's going to cost. So if you see a price in there that's 14 bucks per share, that says to buy one contract is going to be $1,400. So that means then that you will not be able to buy anything that is greater than $10. Otherwise, you're going to exceed the $1,000 trade size. And by your question, I don't know if you're asking if that means you could buy two options. You could buy a $6 one and a $4 one on another one. If you want to do that, that's cool. But understand, buying that $4 option, in theory, you really could have bought two of them and stayed within the $1,000 trade limit or the $1,000 trade size. So when you buy a $6 one, for on that first, that also implies by you saying that you're going to have two open positions at any one time. You're going to find out starting off that you're going to be best off just having one. So I think as you gain experience, you'll be answering your question yourself as you go through that. Okay, hopefully that makes sense. And let's keep right on moving. All right, the next part is to be able to recognize what is the difference between a bull market and a bear market. And to take it even back, it's like, what is a bull? What is a bear? What does that mean? Where does it come from? So the idea on this, it's a Wall Street term that has been used since the dawn of time, if you will. A bull market it's named after a bull, and it comes from the fact that when a bull fights, it uses its horn, picture horns on its head, and it swings its neck up. And so a bull will always swing at you with its horns pointing up, and thus a bull market. A bear market, when a bear gets in a fight, it lifts its paws up and it swats down. And so a bear market is swatting down. So bear market goes down, bull market goes up. What you're looking for is, how do you recognize what kind of market that we're in? Just seeing prices go up or just seeing prices go down just by itself does not really tell you if it is a bull or a bear, right? You really want to see other things in place. And so for a bull market, for example, you want to see that the stock market's rising. It tends to work better if you're in a period of declining or low interest rates. You want to see inflation that's declining and or low, with unemployment rate that is low or declining. And so you look at it now, and then you get income taxes stable or declining, both corporate and individual, and corporate earnings are up. You say, well, what are we in today? Well, we've got a rising stock market. We've got an environment of low interest rates. You could say the way if you listen to the government, you'd say, well, inflation, they will say it's low. But I don't know if any of you have been paying attention, you notice that restaurant prices are creeping up. And you go get a haircut, prices are rising. And when they measure inflation, they don't include, if you go look at the government metrics, they don't include food, they don't include energy. And so two of the biggest expense items in the inflation, in what we spend on, are not included in there. I can't remember the guy's name. There's a guy that puts out a quote unquote report every year. And he started doing this via Facebook X number of years ago. And he sent out a note to his followers around different parts of the country. And he had them track their expenses on things that they spent money on over the course of the year, and then compared those prices on what they spent on them next year. So if they were buying a box of Cheerios on Valentine's Day of 2020, and they bought one again right around now, he'd have them make note of what the price difference was. And he was able then, he published, and I think he still does it. I saw it once, I didn't go back and look at it. I was just more curious that someone took the time to do it. I didn't really care what the numbers were. But you saw different rates of inflation in different parts of the country. So like in Albuquerque, New Mexico, the inflation rate might have been 4%, whereas in San Jose, it might have been 9%. And it was really interesting to see the differences in the geographic differences. And it was also fascinating to see that in not a single city that he queried or that he got data from, none of them were anywhere close to as low as what the government inflation numbers were. It's like, cool. And yet I think we all know that. We just accept it. But yet we hear that government says that inflation numbers are low. But looking at today's environment, right? We've got low interest rates, low inflation. Unemployment still seems pretty high. Right? It came down from the spike that we had with the initial spike due to COVID. Income taxes have been declining with the new administration in place. I don't expect that to be a true statement anymore. I expect that they'll probably go on the rise. And corporate earnings seem to be holding or improving. Right? So those are the traits we've got currently for the current environment. Let's say we seem to be in a bull market. Now let's look at the bear side of things. And before I do that, a couple of text messages and look at them real quick. Tess is asking, Chris, how often do we trade options in the long-term holdings account? And the answer is as often as it sets up. I'll describe a little bit later on in the class as to when we look to sell calls. And it's really whenever that sets up and or your availability. So it's I suppose if your stock is volatile enough and you're sitting there, if you wanted to trade a 55 on options, I wouldn't advise you doing that. There are some people that do. I wouldn't necessarily advise that, but you're going to see setups on the daily or 233. You can take those. And Tess, it's really going to depend on the stock. And it's going to depend on how volatile the market is on that particular point in time and or chunk of months during the year as to when that's available. So unfortunately, I can't give you a hard and fast answer. It really is one of those, it just depends. Let's see. David sent me in a question. What is the strategy if one... So David, the answer to your question is yes, but.
Actually, I'm sorry. I hit the shift button or return button before I was able to finish that up. But the question is, what happens when you, let's say you lose $1,000 on your trading account?
But dude, my answer was great. You gave me a non-question. I gave you a non-answer. I thought it was awesome.
No. But I mean, where do you go once you lose that first 1,000 out of that 2,500? Do you replenish it or do you keep rolling the dice per se?
So his question is, hey, so I'm going to start. So I've got a $2,500 trading account. I have a $1,000 trade size. What do I do if my first trade I have 100% loss? Well, you're going to have 100% loss if one of two things happen. Either you get hit by, well, you could get hit by earnings, but that says you broke a rule. So shame on you. Or you stayed in too long because you didn't want to take a $100 loss or a $200 loss because you thought it was going to come back. And the charts told you that it wasn't, but you stayed in there anyway because you didn't want to admit that you're wrong. And so now you're dealing with a psychological issue that you're going to have to fix. or you just got hit by, we had a 9/11 type event and your trade got decimated. And if that's the case, now you have a $1,500 trading account, and that says that your trade size can't exceed 50%. So now your trade size limit is $750. And so now you have to trade with 750 and build it back up to be 2,500. And if you get another hit and now you lose 750 on that trade, and now your account balance is down to $750, then your trade size is now limited to $375. And so you can only trade $3.75 contracts or cheaper. And eventually it's going to get small enough, you'll never, in theory, go broke. So if somebody says that, takes me to court and go, hey, I lost all my money. No, and it's my fault. They're like, you didn't follow the rules. Because the rules would say you never can go broke. Because at 375, you cut that in half, now you're down to 186. So you have $186.50, whatever that math is. So you can only trade an option that's $1.86 or lower. You're not going to find any.
Oh, go ahead.
I say you're not going to find any.
Yeah.
But
and if you're following the rules, you shouldn't be in that predicament.
Exactly.
I mean, you may have a loss, but it won't be a devastating loss. That's unless it's like a 9/11 event.
And you'd have to have 3 9/11 events in a row.
Got it.
Right? Could it happen? It absolutely could. I've not heard of it happening to anybody. I've had lots of people take their trading account to zero. But if you ask them what they did or ask them, show me what they did, they broke every rule in the book. I'm like, okay, so now you know your way doesn't work. Why don't you do it my way? So, Dave, that's the other reason that you don't put 25 grand in that account. Right? You pay junior college prices.
Sorry. Chris, I want to have the follow-up with that question.
Billy, hold on one sec. David, does that make sense?
Absolutely. Absolutely.
Yeah. And it could happen. There are people, you may have to fund that account again.
Right. I just wasn't sure if you go back to reestablishing the 2,500, where you hang in there and go back and regroup by trading and rebuilding the account.
Yeah,
and
true.
what the parameters would be at that point.
Yeah, your best bet would be to try and rebuild it. But at some point, if you keep breaking rules and it gets down too small, then you've just got to refund it again and start over. But go back to paper, because clearly you weren't doing something correct.
Do the rules.
Go back to paper to be sure that, to be sure that you've got it, that you're on track. And once your results are good on paper, now you start with real money. Emotions are going to kick in like a banshee, especially if you just got whacked before. You're going to be trading very fearful. Anytime you get a little gain, you're going to take it quick.
Yeah.
Right. And now you'll be fighting that battle of, you won't be able to get big wins, but you won't have big losses, but you'll never get big wins.
Makes sense. Makes total sense.
Yeah. Cool. Thanks, Dave.
Thanks. Appreciate it.
You're welcome. Billy, what you got?
At one point that we can add the money again to that trading account.
Say it again. At what point can you add money again?
Yes. How much balance that you need to have, like the lowest balance that we should add more money into that account?
It really depends on what your comfort level is with your skill to build it back up. I've seen people build it up from $500. And I've seen people take it from 2,500 down to zero 3 or 4 times.
Okay, got it.
Right? So that I can't give you a hard and fast answer. It really depends on your comfort level, your skill level, and your confidence in yourself to follow. If you follow the rules, you're going to be fine. It's when what really happens is people don't follow and go, hey, I'm not following the rules, so how much money should I throw at the problem? And the answer is, well, you should throw all your money at me and don't throw any money at the problem and start studying the fucking thing, because you're not following the rules right.
Got it. Thank you.
You're welcome. You're welcome. I heard from people before, just so you know, if it's your first time hearing the live webinar, I had so many veteran students call me the last couple of weeks like, man, I like the new Hansen. He's like, he's not putting up with any crap. You know, he's cursing us out, and, playing hardball with us. And a lot of them were saying, it's like, man, I wish you would have been this harsh with me when I started, because you were more diplomatically, more diplomatic and more politically correct and nice about it. I wish you'd have kicked me in the ass, because it might have kept me from making stupid mistakes. So for those of you to hear it for the first time, if I sound a little bit, crass and rude, just understand, hearing me dropping a few F-bombs directed at you and your thinking is a lot less painful than having the market maker clear out your account. What would you rather have? And I think if you think about it, you're paying money to learn from someone that has done this. You might as, if you want to blaze your own trail, go ahead. But that's stupid, right? It's that old saying, the foolish man makes his own mistakes. The wisest man learns from the success and mimics the success of the successful, from the wise man. It's your call which way you want to go at it. And so in doing that, if you're being steered off course, I'm gonna shake you, grab you by the shoulder, by the lapels, and shake you by the shoulders and shake you and go, hey, I'm gonna scream in your face, quit not following the rules, start following them. Much easier to hear my verbal at you than to watch your bank balance deplete till they go into the market maker. Okay, so back to the stuff. So now you got a bear market. So after the market's been falling for a period of time, you'll hear people on TV coming on CNBC, and they'll be saying, you never want to buy stocks again. It's horrible. It's horrible. The whole world's going to end, right? Electricity is going to fail. We're all going to go back to living in caves and having to go, eat squirrels and possums, because the whole infrastructure is going to collapse. And what you're really looking for to identify that we are in a bear market, the textbook definition is that a market has declined by about 20% or more, which I always kind of laugh at, because that means, so if we're only down 15, 17, 18, 19%, we're not really in a bear market. That doesn't make sense to me. But the textbook definition is 20% or more decline. You'll see that interest rates are rising and or high, inflation is up, unemployment is up, taxes, both corporate and personal, are going up, and earnings are dropping. And you typically will see, if not almost all of those factors in place when we've got a bear market. And you look back, the last time we had a good washout was back in 08, 09. And if you go back and look at the metrics at that point, we had a market that was down more than 20%. Interest rates were not high at the time. Could argue as to whether or not inflation was. Unemployment, we saw spikes in unemployment due to all the real estate debacle. Taxes were going up, earnings were coming down. So all of those factors were in place, right? Then we had new administration came in. They put in the quantitative easing, right? Then we started lowering interest rates. And then what happened? Then the market took off, right? And it took off on a 12-year run, right? And that got us to where we are today. So just something to be aware. When you look at trying to analyze or get an opinion about a stock, you hear me grimacing a little bit. I tweaked my back a little bit yesterday. And so I get up and I stretch every now and then. It's a little uncomfortable to be shifting around in the chair. So if you ever hear me grimacing, it's just because the chair isn't comfortable. I felt like a jackass yesterday doing what I did, moving stuff around. Somebody just sent me a note. Let me just read these real quick. Telling me to kick some butt some more. Yeah, one person said, love it, keep kicking us in the butt. And the other guy said, love it too. Cool. And the second guy that said, love it, I didn't hear that he did an extra 2-minute plank. So he should be, if he's losing interest in what I'm saying in the next couple of minutes, because he already knows this, he ought to be out doing a 2-minute plank during the whole time that I'm talking about this next section. So when you go through and you understand, when you analyze a stock, there's really two schools of thought to measure, to interpret the price movement for a stock. One of them is via fundamental analysis. The other one is technical analysis. In real simple terms, technical analysis is you read a chart. Fundamentals are you read and interpret the company financial statements. which include the balance sheet, the income statement, and the statement of cash flows. Putting that into English, taken out of MBA terms, a balance sheet is what you owe and what you own. An income statement is what you make and what you spend. And a statement of cash flows, think of it in terms of your checkbook. It tracks the money going in and it tracks the money going out. It's way oversimplified, but that's a really simple way to think about it from a big picture. And when you get people that are from the school of thought or the school of thinking from a fundamental perspective, they may look at things like industry trends. And I've got an example on the screen there. They may look at measuring some of the line items in a financial statement, right? Maybe trying to look at book value. They might be looking at the margins that a company is generating. They look at something called EBITDA, right? Earnings before interest, dividends, interest, taxes, depreciation, and I can't remember what the hell the A is. Doesn't matter. But there's all kinds of different stuff that goes into that. And then every business has its own set of measurements, and that's how you're able to compare company to competitor. So I can't really, I worked at IBM for years. I used to book a ton of business at Marriott. Now I was booking it at Hilton. But it's really difficult to compare IBM to Marriott or IBM to Hilton, right? Totally different industries, totally different metrics. How do I decide if I should put my money into IBM or if I should put my money into Marriott or Hilton? But it's very easy for me to compare Marriott to Hilton, right? I can look at things like, how many rooms do they have across the whole chain? Maybe break it down by how many rooms in each category, right? You've got the, whatever they call it, the luxury category. And then I've got the Motel 6 category or whatever you call it, the budget category. And so I can look to do a comparison across categorically, or I can just say across the board, what's their average revenue per room? I just look at the total revenue coming into Marriott, total revenue coming into Hilton, break it out by the number of rooms that each hotel has, and I can see what they get, per night, per bed. And different metrics you can look across different industries. Airlines, they do revenue per seat. So it doesn't matter how many planes they've got. It's pretty natural. If they've got a lot more planes, they should have a lot more revenue. But it's more about what's the revenue per plane. If they've only got one flight going in and out of one airport, right, the fees that they have to pay for landing fees and departure fees from that particular airport are going to be a much different percentage than they might be at an airport where they're doing much more traffic. And so different ways you can measure this. You get into all this stuff. And analysts go to town on spreadsheets, and that's awesome. More power to them. I don't necessarily believe that that's the way to do it. And the reason why I say that, and we saw that just recently, back in March, Boeing went from a price, I don't remember the exact price, in concept, it was about $400 a share. And within about 3 weeks, it dropped down to, I think it got as low as like 175, something like that. And then like a week or two later, it was back up at about, 240, 250. And whenever somebody says, fundamental analysis is better than technicals, I was asking, I say, please explain to me how a stock that is in the Dow that's been around for 100 years, that's a, $50, $100 billion company, whatever it's worth, how does it change its value by about 75% in 1 week? And they didn't release any financials. Please explain to me how fundamentals can describe that kind of change in value of a company and something that is that big. It wasn't like they went and sold a big contract. They didn't come out with a great earnings report. They didn't come out with the big warnings. The stock price, the company value changed well north of 50% within an incredibly short period of time. And yet people will still insist that fundamentals are the way to go. I say bullshit, right? I totally disagree. I think that technicals are a much better way to get a gauge. I can't look at a technical and say that, oh, Boeing is worth this many bazillions of dollars, but I don't care what it's worth. Because what I'm doing is I'm parking my money there. And if it starts to misbehave, if it's something I'm going to own forever, then I'm going to insure it and I'll buy puts. If it looks like it's just on a small pullback in price, then I'll sell calls and generate some yield off the stock. If it looks like it's on a tear going up, then I'll stay long the stock, meaning I just own it and look to make money off of it. And if I really don't like what it's doing, I can push one key. I push, well, let's see, 1, 2, 3, probably about 5 keys on the keyboard. I type in the letter, I push stock trade. Once I log in, I push stock trading. It says key in the ticker. I type in BA. There's 2 letters. I press enter. It comes back and it says Boeing is trading at $100 a share. And I say sell. And it's gone. And that'll take you about 20 seconds. And in doing that, I can liquidate my own personal holdings of Boeing, which could be in the tens of millions of dollars. And my cost to doing that used to be commissions were about $8 to do that. Today, that $8 went away, and now I've got to pay a little bit of an exchange fee. My guess it would cost more to get a pizza than it would to liquidate $10 million of Boeing stock. And my commission is 0. So the barriers to entry on this are none. But yeah, think about it. If I want to go sell a $100,000 piece of property, I'm going to spend $6,000 in commission in real estate fees, plus any other transaction fees I've got to unload the property or to purchase the property. And yet I can do 20 or 30 or 200 times that amount and pay less than I would pay the notary to come out and catch a signature for me. Right? It's amazing. And so when I look at a chart, I can tell what people in the past have believed about it based on where I see their buying pressure and their selling pressure. It's once you know what to look for, it's very easy to spot on a chart. And so it goes back to which approach is better. Is it better to do fundamental analysis or is it better to do technical analysis? If you were to flip through that entire manual that's on your desk in front of you, it's very obvious what my opinion is, because this is the only page where you'll see the word fundamental analysis ever mentioned. And the rest of the book is filled with charts. So it's pretty clear where my opinion is. But you come up with your own opinion. And what's interesting is if you find somebody that understands charts, I've never met one that will go back to studying fundamentals. I will meet lots of fundamental people that once they understand charts will now move to charts. But I don't ever see it going the other way. Now, it may happen. I just haven't run into it. But I've run into tons of people that started off, being schooled, formal schooling in fundamentals, in their job, schooling in fundamentals. And then once they learned technicals, they dropped that and went the technical route. But you figure out which way is best for you. The best analogy I can come up with on that, it is very similar to religion. And that if you find somebody that was raised and brought up in Islam, it's very difficult to get them to listen to your rationale about Christianity. And on the other hand, if you find someone that has been schooled in the Christian school of thought, it's very difficult to get them to want to switch over to Islam. Very similar. But, you have religious wars. You don't see wars so much between technicals and chartists. What you do see the wars in the stock market are between the bulls and the bears. So, but that's the quick basics on that. Next piece. Let me check the messages I got here. Phone's deepen a little bit. One of the people who is a notary just sent me a note back and he said, hey, the notaries are worth every penny. And they definitely are, no question. In fact, if you, there's a couple notaries that are on the phone. If you need one in the area that I live, let me know. I can point you to one. He's very inexpensive, very friendly, very reasonable. You got to go to him though. And if you need someone up in San Gabriel Valley, I know there's a couple up there I could steer you to. And others that I'm sure do it and I didn't know about it. Please don't send me a text and go, hey, reference me, reference me. You'll notice I didn't use their name. So I could put you on the list too, but don't overwhelm me with that. Next thing we've got are the first element or the dynamic or the first piece of what goes into a stock chart. the first thing we're going to talk about this are candlesticks. And while it's the first thing that I mentioned, don't misconstrue that to mean that it's the most important thing on the chart. It is not. It is probably the least important piece of the chart. But the reason I explain it first is because it's the easiest thing to explain. I'm going to show you a bunch of patterns. I'm going to explain a candlestick in just a minute, what all the components are. And then I'm going to show you what it looks like when we have a string of these drawn together. And then we get, and they have names for various patterns, if you will, of these that show up. The name is not relevant. We just use a name so that we both know what type of formation we're looking at. But the name is not of concern to me. It's more important that you understand the psychology that is in place as a result of that formation. Also, it's important to understand that candles are an interpretive piece. And in looking at these, please do not ever look at these from the perspective of having a micrometer. And you don't need to get down to being the precision, level of precision you would see if you're a rocket scientist. This is an art, and there definitely is an art to this. Excuse me, one second, do a quick drink of water. All right, much better. There's a book on the second reading list at the back of the first class manual that's written by a guy by the name of Steve Neeson. And it's called, I think it's called Candlestick Charts or Candlestick Charting, something like that. The book will run you $75 to $100. You do not need to buy it. And it is a tome. If you don't know what a tome is, that's a big word, it's a 4-letter word that you can use. It's not cursing, that means big book. It's probably 1.5 inches to 2 inches thick. It works great as a doorstop. Or if you live, in a high rise and you got to do some damage to somebody down below, you could drop it in a car. Don't do that. Just joking. But it's a very heavy book. You don't need it. What I believe you need are what are contained in about the next 8 to 10 pages, and that's about it. That'll be more than enough to get you going. If you want a better explanation on this or a different explanation, got a web page there you can go to, Online Trading Concepts. And they go through and they explain candles in a similar fashion that I do, maybe not nearly as inappropriately graphic or with, what do you call it? Politically incorrect suggestions of what to do with somebody's book, but you get the point. So when we look at candles, you'll see them drawn on charts in 2 colors. They typically are either green and red or white and red. And I show you the green just in case you want to use them that way. I set up all mine to be white and red. And so when you look at these 2 on the page in front of you, the green and the white have the same descriptions around them. So they're basically the same thing, and the reds are the same. So when I look at a candle, you can see, if I look at the white one, you can see at the very bottom of it, I've got the low going up, I've got the open, the close, then the high. And what that is, the open signifies, it's a way to visually chart the opening price of that candle. If we use it if we're measuring it on a daily basis, then it will be the first trade that was done on that stock for that day. And that would be the opening price. Let's say it's $100. And at some point, let's say that stock gets down as low as 98. And then it starts to head back up. For some, people when it opens at 100, people start selling it for whatever reason, news overnight. And they sell and they sell and they sell, and the price gets all the way down to about 98. And then for some reason, some people step in to start buying, and now the price starts to lift. And now the price rises, it goes up, 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 and it gets as high as, let's say, 103. And so at some point during the day, it's 103. And for whatever reason, sellers show up, and now they start selling it. And by the close of the day, the last trade of the day, let's say, is at 102. And so it opened at 100. It got as low as 97 or whatever I said. And then it rose from there, it got as high as 103, and it closed at 102. And so in looking at that candle without knowing the numbers, when I see a white candle body, that tells me that that was a bullish candle. it closed higher than its open. Now, I don't know what it did relative to yesterday's closing price. It might be higher or lower than that. I can't tell just by its candle. But when I look at the white candle body, that tells me that the closing price was above the open. And that upper wick, which is the section in between the close and the high, they call it either an upper shadow or I call it the upper wick. That shows the absolute high of the price of the day. And the lower wick shows what the absolute low of the price of the day was. And now to compare or contrast that to the red candle that is to the right of it, you'll see that everything is the same on that, except that the close is below the open. So when I see a white candle, I know that it went up for the day. From the time it opened to the time it closed, it rose. But when I see a red candle, it tells me that it dropped on the day. So from the point that it opened to the point that it closed, the stock price fell. Okay, and that's the very basics of what a candle tells you. Now, in looking at that, if I look at that white one, it's possible that the stock opened at 100 and then very quickly ran up to 103 and then fell back down to 97 and then ran back to 102. There's no way to know which was hit first. Was the high price for the day or the low price of the day hit? Which one occurred first before the other? But we know that they both occurred before it closed. And so in looking at the candle, I can't tell whether the high occurred before the low or after. And at that point, I don't really care. When I'm looking at that, if we assume this is a daily candle, if I want to know which happened first, then what I would do is I would look at an intraday candle. And rather than capturing data every day, the full trading day's worth and paint the candle off of it, I might start capturing data every hour or every half hour or every 5 minutes or even every 1 minute, and then plot that accordingly. And so if I plotted it every 1 minute, then I would be able to tell you by looking at that chain or that string of data for the entire day, 6.5 hours, I could tell you when the high price of the day was made and what it was. And I could tell you what the low price was and when it was. But looking at the daily chart, I can only tell you the high and the low. I don't know what time of day it was made. But the smaller time frames would be able to tell me that. Going to the next page. Now we're going to start showing examples of strings of candles running together. And they give them various names. Candlesticks were brought, Steve Nissen, as I mentioned before, worked for Wall Street back in the 60s. He got sent to Japan to work on the Tokyo exchange, whatever he was doing for them. And he discovered that in Japan, they were using these things called candlesticks to track the price of rice in the commodity markets as rice was being sold in the rice exchange in Tokyo. You're in and around the major cities in Japan, including Tokyo. And he saw this and studied it and thought, well, this is really interesting. I wonder if you could do the same thing and apply this methodology to stock prices. Came back to the US and started applying them, and he's considered the father of candlestick pricing in the stock market as a result of having done that. It's been a couple of years, but a few years ago, I was in Japan, took my kid with me. We did a boys trip. And he was about, 9, 10, something like that. And he and I went running around for about a week. And woke up when we stayed, did the range of hotels from a high-end place down to a hostel, just to give them a perspective of what it was like to live, to live the high life, and then to be, thrilled to get a boiled, a boiled instant ramen thing for breakfast before I went out in the street and foraged for our food. And I flipped on the TV one morning in the high-end hotel where we had a TV, and found a business station and couldn't understand a single word they're saying because they don't speak Japanese, but they were showing candlestick patterns. And they were talking about something that Mitsubishi was doing, and you could hear the guy saying, whatever the word is for this formation. But while I didn't understand what he was saying, I knew what he was saying by reading the candlesticks. I could point and understand what he was pointing at. So it's really interesting to see that they're still using them to this day in Japan. So the first formation we're going to talk about is a hammer. And I give you a couple of descriptions there. I've got a definition for it. And then I've got a little blurb on how to interpret it. So a hammer formation happens when price comes down. You can see the 4 red candles. It can be more than 4, it can be less. But I've got a string of candles coming down. And on the next candle, you'll see that the price was significantly lower than its open, right? So it dropped way down. And then it rallied at some point during the day and it closed above its open. And it may or may not have left an upper wick up there. And then from that point forward, the next few candles rise. And that's set, they call that a hammer. It's said to be hammering out a bottom. And all it is that, price is searching for a bottom. It may have found a bottom down at the bottom of that lower wick. And then for whatever reason, buyers step in and they want to own it at that price. And they drive the price higher. And all that's just referred to as a hammer. And then the opposite of a hammer is what's known as a shooting star. And so a shooting star is where you have price rising. And then from there, you've got one day where it shoots up, makes a high, leaves a trailing upper wick, and then falls back down. This particular candle looks to be bullish, but more often than not, they're bearish. And then it it pulls back from there. And that's known as a shooting star. And I give you the definition and the interpretation of that. And as we go through charts later on today in the next few weeks, when I remember, and when I see one, I'll point them out to you to see that, so you can see what they look like, see examples of them. Next formation that you see a lot on charts is what's known as a gap. And there's 2 types of gap. There's an up gap or an upside gap and a downside gap. And what happens, an upside gap is when the stock gaps up, so price has been rising, news comes out overnight, buyers step in when the market's closed and say, oh my gosh, everything's great about this stock, I want to own it. And they call their broker and say, buy it at whatever price it is. Put in a market order. I want it first thing in the morning. And so the market maker, we talked about him or her or the company last session, they see a bunch of orders before the market is open and people are willing to pay up for it. So the market maker will raise the price automatically and think, this is about good enough. And they open the price there. Stock gets there and it runs up because there's all this bullish buying power that's showing there. And on the charts, that shows as a gap. A downside gap is the same thing, but in reverse. Bad news comes out overnight, either on the particular stock, on a particular sector, or on the overall market. People get scared, they want to get out, and so they put in orders before the market opens and said, get me out of this thing. Market maker sees that, lowers the price dramatically, and then fills your order way down low, and you see the gap down. So there's gaps up and gaps down, and they all occur because of some overnight news event that happened while the market was closed. You can see on stocks that are trading during the day, there will be gaps at times. You can't see it on a daily chart. You'll see it on an intraday. And if you ever really want to see it, you're most likely to see it on a 1-minute chart. You won't see it on a stock that has a lot of volume, or at least a big gap on that. Where you see it is on stocks that tend to have little to no volume. And I don't look at those much. In fact, I say much. I don't ever look at those. And so I don't see them on charts very often. But they do exist on charts. You just have to be looking at the correct chart to see it. And this is one of those, just trust me on it. You don't need to go verify it because you shouldn't be trading those kind of stocks anyway. We want something that has a ton of volume, that's very fluid in its moves and easy to get in and out of. And in order to do that, you got to have adequate trading volume on that stock per day. All the stocks on the watch list meet the criteria, so you're totally cool. Then you've got another formation you'll see regularly on charts that's known as a doji. Doji, if you don't speak Japanese, now you have another word you can, biru is one, which buys you a beer. Konnichiwa says good day. Ramen will get you a bowl of soup, and doji means the same. It's probably doji, I think. But either way, doji means same. And a doji is a single candle, and it forms when you've got the open and closing price being virtually the same. And it could have a small little body in there. It's all relative to interpretation, but it's basically essentially the same open and closing price for that candle period is known as a doji. And now there may be periods of time where that doji has a large move up and then it pulls back down, so you're left with a large upper wick. It may have or a large lower wick. It may have just one of those, either large lower or upper. It may have a large of both, and it might have none. It could be that the only activity during the day was all at about the same price. Any one of those are fine. They're all referred to as dojis. The way to interpret that, what it says is every day the market is open, you've got a battle going on between the bulls who want price to rise and the bears who want price to fall. And they're exerting their strength by going in and buying and selling shares. And so at the end of the day, if the candle body is large and it's a bullish candle body, you could say that the bulls won that day because there was more buying pressure. If you had a large candle body that was red, meaning it went down, then you could say that the bears won because there was a lot more buying pressure. Selling pressure. But when you have a day where you have a doji, what that really says is the bears and the bulls canceled each other out. It's pretty much kind of a draw. However, you could view it a different way. Because imagine that you had a string of candles before that. So look on the candle formation on the left there, the doji. What if you had a whole bunch of bullish candles coming into that? And so you've been going up, 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 up for the last 4, 5, 6, 8, 10 candles. And now suddenly you see a doji. You might say, well, yeah, it's a draw. The bulls and the bears won, or they fought off to a draw. You might also interpret that to say, you know what? The bulls had been winning all along because that was what was driving the price up. But now they're not, right? And the bears were able to step in and stop them. So just something to think about. For those of you that are sports fans, it may dawn on you at some point that the two major sports teams in Chicago have stock market names for their teams. I don't think that's a surprise. I don't think that was by accident. My own personal opinion, but either way. Next page. Then you've got something known as an engulfing candle. And so we've got a bullish and a bearish engulfing. A bullish engulfing is here. You can see I drew the candle bodies to be green just to confuse you. And what happens is you'll have a bearish formation. So you'll have price going down, 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 down. The next day, price will gap lower. You can see the open of that green candle with the arrow pointing at it. You see the open of that candle is below the close of the prior day or the prior candle. And then it may have fallen a little bit more, and then it rose on the day. And you can see that green candle body engulfs the red candle body. And that's said to be a bullish engulfing pattern. And the interpretation of that is that it may be to an end to the decline that has been occurring. Okay, then the opposite of that would be a bearish engulfing. And a bearish engulfing is just the opposite. Price is going up, 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 up. And then you've got a red candle that gaps or that is higher than the close of the prior. And then its candle body engulfs its neighbor, just like what we see here. Now, remember what I said about candle bodies. The engineers of the group right now are leaning in close and they're looking around on their desk trying to find a magnifying glass because they're looking at it saying, wait, is that red candle? That looks like the opening price is just a hair under the closing price of that green one to its left. How is that an engulfing pattern? And my answer is, if you ever have to get a micrometer, you're in the wrong space in the stock market. This is an art, right? It might be a smidge under. I don't fucking care. The idea is that it is engulfing its neighbor. It's off by a penny or two or a dime or whatever. That's fine. But understand the interpretation of that. It's very clear from that candle formation that sellers stepped in. Because look at that candle. See that very long upper wick? At one point during the day, so you can see where that red candle opened up, right? It's at the top of that candle body. That was its opening price. Based on that candle formation and experience, I would probably venture to guess that that candle at one point during the day was a big old green candle that went from the open all the way to the top of that wick. And then for some reason, people said, uh-oh, time to sell. I'm happy getting profits. And people started rushing for the gates, rushing for the exits. And all the selling pressure came in. And the stock dropped from the tip of that candle at the top all the way down to the bottom. And then it lifted a little bit at the close, but it basically had that big of a decline at some point starting in the day for the rest of the day. That's a bearish indicator, or that's a bearish signal, if you will, that says, uh-oh, this thing might be reversing. No longer is it continuing to go up. And then it's borne out by what we see over the next few candles. That's known as a bearish engulfing. Next one we look at is what's known as a falling three method. You can see the definition or the interpretation.
Chris, can I pause you for 1 second?
Please. Corey, I already know what you're going to ask.
The engulfing?
Yep. You're going to say, what about right here? This one was engulfing, but then it rose from there.
No, I'm more wondering on the one that does the engulfing, does it simply need to be larger than the prior, or should the open and close exist above and below the prior? In your example, the tops line up, but forget that part. If the tops didn't line up, if the red was below it a little, as long as it's bigger than the prior candlestick body, it's engulfing? Or should one exceed the top and bottom of the prior?
Corey, don't go that granular. Take a big step back.
All right.
So, Corey, here's a better way to describe it. Tell me your environment right now. Are you sitting at a desk with a computer right in front of you on a desk?
Yep.
Do me a favor. How far is it to the furthest corner of your room from where you are?
I don't know. 15 feet?
Cool. Do me a favor. Stand up and walk to that furthest point away where you can still see the screen.
Yep.
And talk to me when you're there. So if you got to yell real loud so I can hear you, go ahead and do that.
Okay, good.
Now you're standing 15 feet away. Corey, looking at it from there, does that look like that candle's engulfing the green one?
It's bigger.
Yeah.
The red candle is bigger.
Yeah, but so from 15 feet away, it looks like it's engulfing it, doesn't it?
Sure.
Yeah. So that's how
enough.
you want to think about it.
Okay.
And I'm thrilled that you asked that. Anytime as we go through charts too, where I'm going to show you how to read the other indicators. If ever you're in doubt, this is a huge hint for you. And Corey, I'm glad you asked. I'm going to direct it at you, but it's really directed at everybody.
Yep.
And Corey, we've spoken. I think you know me well enough. I'm not attacking you. You're not taking it out.
No problem.
So Corey, his initial reaction was to put a nose print on his computer screen or in the manual to see, man, is that thing really above it or not? If ever you're in doubt on this, the trick in the stock market, don't put your nose up to the glass. Put your ass up on the furthest wall away from where you are. And then look at that picture and then decide from there. Because if it's obvious across the room, then you know you got something.
Let me rephrase the question maybe. You see the red one that's to the right in your purple circle, right?
Yes.
The next red one below it. From 10, 15 feet away, I can tell it's larger than the red one prior.
Yes.
Is that considered engulfing just because it's larger? Or is it not engulfing because it doesn't exceed the high and low of the prior day?
So Corey, you can see my mouse here?
I can.
Okay, so which count we're not referring to these two?
Well, let's take the red one, right?
This one?
Let's pretend that's green. You go to the next one over. They don't line up in any way, but I can tell it's larger, even from a distance. Is that all I care about to make it engulfing?
No, so what I want to see is I want to see that the candle body is engulfs this one.
Okay, so
of course,
the top of the red needs to be higher than the prior, and the bottom of the red needs to be lower than the prior.
Yeah, let me answer the question the way you didn't ask it. Let's say that this red candle did not exist.
Yep.
And so I have this green candle, and then the very next candle is this one.
Yes.
That's not engulfing.
Perfect. Got it.
Does that make sense? That would be a gap, right? Because they'd have a gap from here to here.
All right, I'm going to ask you one more question. I see two dojis on this screen, but they're green. Do I care about the color?
So I could argue this, I might call this a doji.
Okay.
It's a very small body candle. This would be a small body. I might call it a doji. This to me is a doji.
Yep.
This and more of a small body. This is a doji also.
Okay. So colors are relevant. It doesn't have to be black because there was zero change. As long
That's
as that
correct.
body is very thin. Okay.
Yes, exactly.
Got it.
And so Corey, great question. So on this one, when I look at this, I don't really, here's a different way to think about it. When I see, think of the size of the candle body is how much gas is in the tank.
Sure.
And so at this point, a little bit of gas, almost no gas. Oh, a lot of gas, some. Whoa, a lot of gas right here. More gas. Okay, this thing's coming down hard. Right? Now it came down, it slowed down a little bit. Now it paused. At this point, this might tell me that maybe this move is done. Right? Because we've been coming down and it lost a lot of its steam.
Okay.
This is way advanced, and a veteran student will recognize this, Corey. This will go over your head, but I'm going to do this for the veteran students.
Sure.
If you've been through this before, you might actually be drawing a line. If these three candles didn't exist, so if this doji is Monday, Tuesday, Wednesday, Thursday, when we're doing our homework Monday night, and you see that it's down here, it wouldn't surprise you to see it pause, because notice how price held right here for a little bit for the veteran students, right at the same price point. And Corey, I'll explain that a little bit later too.
Sounds good. Thank you.
Cool. Does that make sense?
It does. Yep. That was perfect.
Awesome.
Thank you.
Awesome. Great question. Thank you.
Hey, Chris, I have a quick question for you. On the green, the closing price is up, and then next to it is the red candle opening. Does it, to qualify as engulfing, does it have to, aside, I mean, it's one of the criteria, it's not the only one. Does the price open on the red have to be at the same close level that the green was at? And then engulf it and go farther down?
So Dave, when I read this, it says followed by a larger bearish candle that completely engulfs the prior candle. So I'm looking for body to body comparison.
Right.
But, and again, don't get out, this is what I was saying before, don't get a micrometer, right? Because you look at it and say, that red one, I mean, if I got my nose right up to the screen, that might be 3 cents under that green, the top of the green candle. You know what I mean?
Right. But what if it's a couple bucks higher? Is it still considered engulfing?
So if this candle body, let's say were the full length of this, let's say the wick wasn't a wick, but it was actually fully red.
Right. Well,
then that would clearly be engulfing the green.
Okay.
Chris, I have a question. Is
the opening price and the closing? I mean, the closing price on the green doesn't have to be relevant to the opening price on the red candle that's declining.
Dave, do it this way. We're going way too deep in the weeds on something that's not important.
Okay.
Yeah, go with me a little bit, and you'll see as we get further into it. What you're asking is not. It may seem important. I'm not trying to blow you off. It's not relevant for when we get into this.
Got it. Okay.
Cool.
Chris,
Thank you.
Rowan, last question. We'll keep going.
Yes. Is there engulfing? The first red one is also engulfing on the
You're
left.
looking at this one?
Yeah, this one. Yes. Is this also considered? Okay, cool.
Exactly. Yep, that would be engulfing as well.
Okay.
Cool. Let me keep going. Hey, I just realized, just so some of you, to give you a perspective, some of you are saying, oh man, you're cutting into my Valentine's Day. So just to put it in perspective, there's a guy on the phone who I think was on a call earlier today that was at 3:30 in the morning his time. He had come in from a night of clubbing down in Melbourne, and now he's on a call here. So it's probably 6 in the morning for him. So he's getting up bleary-eyed and probably hungover. So welcome, Australia. And then we've got a guy on the phone in the middle of nowhere, Africa, that is at I won't name the base or the country, but he is the base commander of a UN base. And some of you are saying, I don't really want to be doing this. This guy is sitting here in the middle of they're helping out between two disputing countries. Neither one of them is the US. He's in there as a rep for the UN on that. So for all of you doing this, I do not want to hear your bitching about the time of day we choose or anything else. I got people in here that are going way out of their comfort zone to do this. Total respect for them doing it. We keep on going. Falling 3, I think that's where I was before. So on the falling 3, what you'll see on this is you've got the definition and the interpretation. So you see the price is falling, and then we get a large down day, signified by this big red candle. And then I get a few up days. And it could be 3 days, could be 4, could be 5, could be 8. I'm not worried about the number of days. What I'm paying attention to is that these rising candles don't violate the top of the candle body nor the bottom of it. It's almost like price is falling, 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 and people say, oh my gosh, it's so low, let's buy the dip. Excuse me, and they step in and they start buying, and price slowly rises for a few candles. And those that bought in, now the smart money says, good, we got the price to rise, let's sell it some more, we'll get a higher price. And this is a GameStop example. Price rose, sellers come in, boom, drives down even further, and then it falls from there. This is what's known as a falling 3 method. So you'll see price on a decline, a large down day, followed by a few days or a few candles back up, and then it continues its down move. Okay, all it is, it's a consolidation pattern that occurs in that chunk of time in there. Okay, and then we have, that's a falling 3, then you also have a rising 3, where price is rising, you get a large up day, followed by a few days of down that don't violate the candle body of that large candle, and then the price dropped a little bit, buyers step in and say, cool, let's drive this even higher. They buy here, it drives it up even more. Okay, so there's a rising 3 and a falling 3. And you'll see these throughout on your when you look at charts. Then we've got another couple formations. One's known as the tweezer top. The other one is known as the tweezer bottom. In order for me to describe these, I've got to use terminology and examples on things that I haven't taught you yet. So we're going to come back and cover this later on in the day when I've shown you a few more things on the charts. All right, let's do this real quick. I got a couple questions that came in. I'll answer them, and then we'll... Oh, Roman extra. Roman, I've heard that extra is awesome. I think that's on my list. Jamie, thank you for that. Amortization, I appreciate it. 2 airplane crashes. Oh yeah, it'd be 2 9/11 events. Cool, cool, cool. Got it. Billy, how do I recognize buying pressure versus selling pressure? Great question. So Billy, let me go back and answer it this way. When I see price coming down like that, going down, 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 that is not buyers. That is people going in and selling. And Billy and everybody, what causes, I said this before in class 1, what causes price to rise? And what causes price to rise is not some news event, that may be it. What causes price to rise are people buying. And what causes prices to fall are people selling. And so when you see price dropping like this, that says that there are people selling. When you see price rising, like there was another one, where to go? When you see price rising like this, price isn't going to rise like this if people are selling. It's going to rise because people are buying. And simply that's how you're able to tell whether it's buying pressure or selling pressure. John, good point. Getting wrapped up and engulfing. Thank you for that.
Hey, Chris, this is Tony Wang. Can you explain to me again what the rising 3 method is? Like, what is the 3 that you're looking at?
So if I look at the rising, so what I'm looking at, see, so on rising 3, price has been rising, and now I get a large up day, right? So I get a big body candle in that box, and then it pulls back, it consolidates for a couple of days. Could be 3, I'd say, I'm equating days and candles because this could be on a smaller time frame, it doesn't matter. But it pulls back for a period of time. Could be 3, 4, 5, like I said, 8, 12, doesn't matter. As long as it doesn't violate that candle body. And then for whatever reason, buyers step in and drive the price higher, and it continues along its climb. So remember what I said early in the class. Don't try and understand all this. It's all written here. And because some of you are going, well, when would I use this? How would I use this? Like, you're fucking way too far ahead. We're at 1 + 1 = 2. And even in letters, this is an A and it makes an A sound. This is a B, it makes a B sound. And you guys are trying to write Shakespearean books. You still got to figure out what all the letters and the components are before we start authoring some best-selling novel. We're just getting into the basic building blocks here. Okay?
I really appreciate it. Thanks.
That was pretty funny, Chris.
Which one?
Writing Shakespeare with A's and B's.
Yeah. You know, I appreciate that. The worst thing about doing this class, I know I've got a pretty good sense of humor and I've got a really biting wit. It really sucks when I make some smart ass comment and I don't get the twinkles in the eyes of people. Because when I don't hear anything, it's like, oh, I bet that was an asshole comment to make. But so I do appreciate the feedback occasionally coming back to go, no, man, you're not being an ass. You're making us laugh. That's the intent. So cool. Here's what I want you to do for your next 4 minutes. If we were in the live room, I would have you turn to your neighbor and one of you take the first 3-4 formations and describe it, and the other one take the next one. Since you don't have a neighbor and you have no one to talk to except your computer screen, be sure that your mic is on mute, and I want you to talk out loud. Don't read the description. Repeat it back as best you understand it and describe to yourself the candlestick formations I gave you. I got 326. I'm gonna run downstairs and grab a glass of water. I'm gonna start back up again at 331. Do not get up out of your chair until you've said these formations and explain them to yourself in the next couple of minutes. And I'll start back up again at 331. I'm gonna mute myself, mute yourself too, and I'll be back in 5.